You're listening to the E-commerce Impact Podcast, where we share the latest marketing strategies to grow your e-com store and have more impact. Hi everyone, and welcome back to the podcast this week. So today I've got a really exciting guest for you. We have got here with us Stephen Duke from Wayflyer. Now, Wayflyer are one of the fastest growing and exciting finance platforms for e-commerce businesses. So Stephen has kindly come along today to help us demystify all the ins and outs of financing your e-commerce business growth. And he's going to talk in a bit more detail about the option of taking finance rather than going the investment route or the bootstrap route as well. So you should walk away from this episode with a really clear idea of what options are available and what you might need to put in place and plan if you are considering taking some kind of finance to grow the business. So Stephen is the global head of marketing at Wayflyer. Before Wayflyer, he worked at Let's Get Checked, a D2C healthcare company that he grew to an 8-figure business and ultimately a unicorn. So suffice to say, he knows a thing or two about the world of e-commerce. Now, in the last 3 years, he's actually spoken to over 400 of the world's best e-commerce businesses and learned about the different ways people are funding or financing their growth. So there'll be a ton of value here for you guys today. So Wayflyer, by way of introduction, since being founded in 2019, have provided over $1 billion to over 1,500 of the world's top e-commerce brands. And Wayflyer customers have recorded over $13 billion in revenue in the last year. So a pretty impressive growth that they've had as a business, and a pretty important part of many e-commerce's successful growth has been being able to access finance in this way. So welcome along, Stephen. It's great to have you here.
Thanks, Jessie. How are things?
Yeah, good, thanks. We've just got COVID in our house, so we're just working through that, but I haven't caught it yet, so we'll see. Cool. So I would love to start off by asking you, why do you think e-commerce businesses even need external funding? Some businesses say they're doing fine as they are. They want to bootstrap. They don't want any other maybe risk involved. What do you think are the reasons to think about getting external funding?
Yeah, so I think there's one main reason. What I always say is that e-commerce businesses are great businesses for a couple of reasons, but have one big problem from a finance perspective. So the really good things from a finance perspective about an e-commerce business is that you tend to have really good profit margins, right? So typically, you're looking at north of like 50, 60% gross margins quite often. Yeah. And like if you're running stuff well, that can translate into 20, 30% net margins. And so that's an awesome business. And then the great thing as well is like how scalable they are. So if you get a product, it's working, you can easily scale that without having to hire, dozens and dozens of people or like build out new product ranges. And so they're all the really good things. But there's one big drawback, which is that e-commerce has a massive working capital problem. So I can tell you a bit about why that exists and then why that means that they very often need external funding.
Yeah.
So working capital is all about, how you manage your cash flow, like the day-to-day, week-to-week, the money that's in your bank account, making sure that you can pay your wages and pay everything, cover all your expenses that are coming in. And the reason that e-commerce has a working capital problem is all actually because of the suppliers. So most e-commerce businesses are getting their goods manufactured, usually in Asia, particularly in China, and they don't get terms from their suppliers.
Right.
So what that means is that they often have to pay upfront for all of their products before they get made and before they get shipped, and definitely before they sell them. So that means that they have to put out all of this cash before they're ever making any of their sales.
Yeah.
Right. And so if you're fast growing, if you're a seasonal business, you're always trying to invest ahead of your growth, which means that you have this massive working capital problem. And so that's often why a lot of these businesses need to go out. It's really to buy stock. That's the main reason. You have to buy stock, and if you're out of stock, you're not making any money. And so that's the biggest reason that we see people needing external funding.
Interesting.
Yeah.
Yeah, because the marketing should give a positive return on ad spend. Like if it's not, then, you'd have to have VC backing behind you. If every transaction is losing you money, then that's something to worry about. So the marketing in a way funds itself because cash in equals cash out. So that's interesting. Yeah. The point is there's this huge outlay of the product. And does that differ a lot from other industries versus e-commerce? Like you say that e-commerce has a problem versus other industries. Are you saying that they don't have the same outlay upfront in the same way?
Yeah, totally. So a couple of examples. If you're a software provider, like if you're a SaaS business, right? First of all, you don't have to buy goods. Like your
Yeah.
main costs are actually just your salaries. And so they're actually pretty consistent month to month. And then when your customers pay, often they're paying up front. So you'll see every time you subscribe to something and they're always like, oh,
Annual.
get the annual bill and it's cheaper. It's like, why do they do that? That's all to solve a cash flow problem, or that's all to make sure that their cash flow is good. So they're able to do these things where they get all the money in up front and then they have the costs come out over the course of the year. And there's lots of businesses similar, like, education business or courses businesses, or lots of agencies are actually similar depending on the payment terms that they give to the companies that they work with. And so it's all just about kind of the cash conversion cycle. And it's a particularly tough problem for e-commerce businesses.
Yeah, interesting. And I imagine more like bricks and mortar, more established businesses can negotiate because of the number of products they're buying. They can negotiate better terms than a typical startup e-com can with a supplier. So yeah, that's really interesting.
Exactly.
Okay, so that's why they need some money from somewhere. Why the external funding route versus taking investment versus, I don't know, growing really slowly and building up your cash reserves in that way?
Yeah, so I think let's unpack that. So the first one is some people just don't want investment. They don't want to work with external funding providers. And often, like, that's completely fine, right? Because it's a trade-off, right? It depends on what you're actually aiming for. And some people are actually very happy to just, grow slower, just keep things kind of ticking along. Maybe they don't want it to be that big of a business. It's really just more about it being a lifestyle business. And that's perfectly cool, right? And that works. If you're relying on, using your own cash, it's really, really tough. Like, it's really tough, especially if you're trying to grow, because if you're growing, you're having to buy more stock now than sales that you have now, right? So if I'm thinking about, well, how much am I going to sell in, February or March next year? If I'm growing, it's going to be a lot more than what I'm selling today. So I need to buy way more stock. And then when you think about external providers, there's actually a lot of different options, right? So I think including using your own cash, like I have 7 different options that people can use to actually like fund their business, and go through each one of those. And kind of there's different trade-offs, right? Depending on what stage you're at, depending on what you need the money for, depending on what your own goals are. It's really like, there's no one perfect answer. And what we find is most people are using a combination of them or changing them as they grow.
Yeah. Interesting. Yeah. Yeah. I spoke to a founder the other day who's grown quite significantly. And he said, bootstrapping was so stressful because it felt like he was always, just one bad check away from complete collapse. Whereas having finance can give you that peace of mind that you can get through a slightly tougher period as well, where if your forecast doesn't quite match what reality, happens in terms of the sales, because we all know how hard it is to predict how is paid social going to perform, how's going to perform, what's happening out in the world today. So just having the availability of credit can really take the pressure off and make you be able to focus more on the long-term picture, right? Okay.
Totally. So that's actually on that point. So what we say is like, we advise people to be holding a 12-week cash buffer, right? So if your sales stopped tomorrow, do you have enough cash in your bank to like cover your expenses for 12 weeks?
Yeah.
Right. And so that's just, if you have that, you've got peace of mind, right? That if something did go wrong, it's not like you're going to have to like shut down.
Yeah, I've heard that as a rule of thumb for lots of business types, 3 to 6 months, like cash in the bank if you can. Yeah. Okay, so what options are available to them then?
Yeah, so we've got, I like to categorize it into like 7 options. The first one is use your own cash, keep it, stay bootstrapped. To talk about that a little bit. The second one is credit cards. And this is where a lot of people will start off, especially for their marketing spend, right? Pretty much everyone is using a credit card of some description.
Yeah.
Then we've got your classic bank loans. And I can go into like the pros and cons of each of those. The fourth one is raising equity investment. Right. So this is whether it's VCs or just like a family friend, private equity. The fifth one is crowdfunding. This is something that's been like pretty popular and can also be a pretty good way to raise some money. And then the last two are inventory finance, which has been around for quite a while. And then the seventh one is revenue-based finance. And I think we'll probably spend a bit of time going into that one, particularly because that's what we do at Wayflyer. And probably, I'd say, the most popular ones for most of the fast-growing businesses. So they're kind of the seven that I think about it. Happy to kind of chat about the pros and cons of specific ones, if that's helpful.
Yeah, just give us a quick run through, because that's quite interesting. I think for a lot of listeners, this might be new. For some of them, they might know a few of them, but not, haven't really thought through all the different options. So yeah, just give us the top kind of pros and cons for each.
Yeah, sure. So let's start with credit cards, right? So credit cards are great because one, they're usually easily available, even quite early doors. The second one is if you pay them up on time, usually you don't have any like fees or interest rates on them, right? So that's great. And then there's actually also like a really nice personal benefit, which is if you've got a good points plan, you can actually earn like some nice rewards off them as well, which can't be ignored. But the downsides of them is that if the fees can rack up and the interest rates can rack up like pretty quickly if you're not able to pay them off every single month, right? So they do come with high interest rate charges. And then also like usually the funding amount will not be that high, right? So usually if you're growing, you're going to cap that out eventually and you're going to need way more money than what your credit card is going to be available to do. So I think it's like really good way to buy ads, and especially in the early days, it's a really good source of capital if you can pay it off and you know that you're confident you can pay it off before the interest rates. But then as you grow, typically you're going to expand past that and need other sources of capital as well.
Yeah.
Then the next one is bank loans, right? So this is kind of the classic one. Pretty much every business owner is going to think about, oh, well, I can just go to my bank and get a loan. If you can, great. That's typically what I say to e-commerce businesses. However, the big challenge is that most banks actually won't provide loans to e-commerce businesses for two reasons. One is they don't get them. They don't understand how e-commerce businesses work. If you run a restaurant or a cafe, they're like, oh, okay, I get it. Like I can understand your business model and they're happy to fund it. The second one is that if you're an e-commerce business, you don't have many assets and just want assets as collateral so that if you don't pay them, they can take the asset. Whereas like, most businesses, like you don't own any massive fixed assets typically. Like your assets are your stock, which is quite small. So typically they're not readily available, but if you can get them, they can be quite good. But again, just need to be careful because like one, they're a massive time drain quite often. Like you're talking about like writing business plans and big loan applications for like up points and end. And then they can come with like pretty complex like terms and covenants and everything like that as well.
Yeah.
Will I keep going?
Yeah.
Okay. So I think so we talked a bit about credit cards, a bit about bank loans. The big one that people talk a lot about is obviously getting equity investment, right?
Yeah.
And so this equity investment can work really well, but for certain circumstances. So what I always recommend is that use equity investment for investing in your long-term growth and be very careful about how much equity you're giving up.
Definitely.
Because it's a few reasons. Ultimately, it's your business. You're the one who's going to be putting the blood, sweat, and tears into it. You want to own as much of that business as possible. The investors, sure, they'll give you cash. But they're not putting in the work. They're not living and breathing this business every single day. And so if you sell 20% of your business, that 20%, that's gone. You're not getting it back. That's 20% of all future profits. It's 20% of your ownership. If you sell the business down the line, 20%, that's it. That's gone and it's going to the investors, not to you. And so it can be very tempting if an equity investor comes to you and offers you this nice cash injection, but you really need to think about what the long-term costs, because short-term, you don't feel like there's a cost, right? Because you don't notice it. But there is a big long-term cost. I've seen this multiple times where you've had businesses who've had really, really successful exits. And then you ask, well, how much did you own at the end when you sold it? And they own a fraction of the business because they've just sold so much of it to equity investors along the way. Second downside is just control, right? A lot of people start their own businesses because it's what they want to do. They want to run their own thing. They want to have the creative freedom to build the products that they want to build and go after the mission they want to have. Once you take on equity investors, that gets more complicated, right? They've got skin in the game now. They want to see a return on their capital, and you're going to have to manage that. It just adds a different layer of complexity to it.
Yeah.
All that said, it can work really well if you've got a business that you want to grow and you're confident in selling a small amount of equity. If it's a good deal, if it's an investor that you're comfortable with, you think they actually bring something to the table, it can be a really good idea. And what I would say is just make sure you're investing that money in long-term growth. So make sure it's going into, product development or building out your team or like long-term growth strategies. Don't get it and spend it on marketing or spend it on stock. That's stupid.
Okay, interesting. And what, in terms of taking investment, like what are the main sort of categories of investor that you see? Like you mentioned friends and family, there's like VC funds. Like, do you see there being a big difference between them, or is it all much of a muchness?
That's a good question. I mean, I think they come with different trade-offs. So the big thing to be aware with like VC firms is that typically they need really massive outcomes from their investments for it to make sense. Because how they invest is, they'll put 20 investments in and they're just reliant on one or two of those being massive. And then it doesn't matter if the rest of them fail. So they're going to want you to go for broke. And so that's something you need to be very careful of. If you're taking on a VC investor, they're going to push you to be like 10x, 100x stars that you are, right? Friends and family, they're not going to want that. But they're probably, depending on who your friends and family are, they can often be like super controlling or demanding, right?
Yeah.
Because like this, it could be a
Panicky.
Panicky, and it could be a large portion of like their wealth that they put into this. Yeah. And so they're going to be probably knocking on your door and like, so how's this month's sales going? How's this week's sales going? Are you ready for this? Can I get my money out or whatever else? So again, depending on who they are, but just another trade-off to think about. And then I think probably some of the best ones are like when you can get like strategic investors. So either individuals who are in your space, right? Who are maybe running a bigger brand than you, and they're just like a few more years down the line. Typically, like if they're high net worth, they can be quite nice because they're not as panicky, as you said. And they're actually bringing something to the table, right? They're able to help you with introductions to retailers, or they're able to actually advise you. That can be pretty beneficial.
Yeah, interesting. Cool. And then is the last one revenue-based finance?
Yeah, so there's a couple. I mean, the other two, which I don't think are worth spending too much time on, is crowdfunding. I think everyone's pretty familiar with that. It can work well. And then inventory finance is something that used to be in vogue, but not really anymore. So this is where kind of you can go and use an inventory finance provider to basically fund your stock purchases. But the drawback with that is in e-commerce, because you have quite high markups, the value of your stock is not that much, right? So if I'm buying if I'm going to sell, say $400,000 worth of product, the stock for that might cost me $100,000.
Yeah.
Right. And an inventory finance provider will only finance you based on the value of the stock that at your purchase price, not at what you're going to sell it at. So you're going to trade off, you're going to get a lot less money, basically.
Yeah. Right.
And so the last one is revenue-based finance. And revenue-based finance is how I would say the majority of the top e-commerce brands are now funding their working capital needs.
Yeah.
And so what revenue-based financing does is it kind of takes the best bits of all of those other funding options that we talked about and kicks out a lot of the bad bits.
Yeah.
Right. So what's good about it is, firstly, it's super fast, right? So we assess your ability to get funding based on the actual analytics and performance of your stores. We plug into like your Shopify store, your Facebook, your Google, and we're actually able to make a decision super quick on whether you get financing or not, like within 24 hours, which is amazing. No, like month-long application processes. The second one is that it's repaid as a percentage of your sales. So if you were to take $100,000 from Wayflyer, it's not that we say, oh, you got to pay us back, $10,000 every month for 10 months. What we actually say is we agree on a certain percentage of your sales that will be used to pay back the money.
Right.
And then once it's all paid back, that's it. You're done. The benefit of this is if you hit a slow month, if you have a slow week or whatever it is, if you hit a bit of a rough patch, you're not tired. We're not saying, hey, you owe us the 10K this month. Where is it? No, we're just taking your percentage. And so it's all about being like very aligned with your cash flow. Because we know that e-commerce businesses have pretty lumpy cash flow.
Yeah.
And then the third thing is like, you can actually get quite a lot of money through revenue-based financing because we understand e-commerce businesses. All we do is actually provide funding to e-commerce businesses. That's it. That's our game. And so when we look at the analytics, we're forecasting your sales. We're not like the inventory finance providers who are looking at the value of your stock. We're actually saying, oh yeah, we know you're going to sell that for $400,000 and we're confident that you're going to do it. So we can give you a lot more money and we can do it at a lot better rates, purely just because we actually understand the risks and the probabilities associated with e-commerce businesses.
Interesting. So I'd love to dig into that more because it's for me as a, agency owner, expert in the e-com growth space. I'm always looking at a brand financials from a cost per acquisition basis. And we're trying to give them a lot of guidance on like what's good versus the industry. But I'd love to hear it from you from a more finance perspective. Like, what are you guys looking for in terms of performance of an e-com and what should they be aiming for in terms of KPIs?
Yeah. Really good point. So a couple of things. So we do have, first of all, we have like a minimum threshold of revenue that we look for. And so that's about 20K a month. And so if you're below that, unfortunately, like just revenue-based financing is not yet an option for it. The reason we do that is because we need consistency and we need predictability in like future revenue, right? So that's the first thing. Average monthly revenue above 20K a month is like a good start.
Yeah.
After that, what we're looking for is basically just like the basics of like a strong financial position. So what we mean here is just the fact that, you've got some cash in your bank account. You're not like constantly overdrawn. You're showing basic financial hygiene, I would say, in terms of like how you're managing your accounts and how you're paying your suppliers and all this sort of stuff. You're not constantly just living off an overdraft or overdrawn or like credit cards. And then we do also look at exactly the types of metrics that you look at. So your CAC, your LTV, your return on your ad spend, because that all builds a picture for us on like how sustainable a business you are.
Yeah.
And our ability to like forecast your future sales, which is what gives us confidence.
Yeah.
Now, we don't have specific numbers because it's different for every industry.
Yeah.
So we know that different categories will have different CAC to LTV benchmarks, right? We know that some of them, it's actually like for some categories, it's all about the first purchase. This person is never really going to come back and buy another. I don't know. I'm trying to think of something like if it's a massive home and furniture store, right? Like how often are you going to buy your sofa, right? Probably not like several times a year. So therefore we know, okay, this is all about like the return on your first purchase. However, if it's something like dog food, then we're like, okay, this person's coming back every single month. So then we're analyzing it a bit differently.
Yeah. Interesting. I mean, that's interesting to me. Like, I'm surprised actually that the bar is quite low, quite easy to get to, because you can bootstrap to a 20K revenue pretty easily if you've got a good product and you've got a good idea about branding and, get some good advice on your marketing. So to get to that bar, I would say someone would probably need to invest, I don't know, 20 to 50K of their own money first to get there. And then from there, you can get finance. And as long as the business model works and the product market fit is there and the market wants what you need and there's scalability, then you can take finance to actually grow. So it's like the barrier to entry for e-com is still pretty low when these financing options are available. It's interesting.
Yeah, totally. And what we find is like once people hit that bar, they're actually able to use Wayflyer as almost their only source of funding. So we have a lot of companies will basically use us for all of their inventory purchases. So they will just say, they'll even sit down with us and say, Stephen, here's what my next 12 months of inventory purchases looks like. I'm going to need to buy 200K on the 2nd of February. I'm going to need to buy 400K on the 3rd of May. And we'll say, okay, perfect. And we'll put a plan together to get them the cash that they need at each one of those points. And so they're basically just don't need to worry about having the cash for their inventory purchases. They know that they can use Wayflyer to get the cash, make the purchase. And then when the products come in, the sales are there, and then they're paying back as a percentage of sales. So it all just works out. So we've had customers who could take, 14, 15, 16 tranches of funding because they're just thinking about us as just the working capital solution that allows them to buy inventory, spend on marketing, whatever it is that they need to do.
Yeah. So interesting. And so at that minimum level, just talking about that, so minimum 20K revenue, what sort of borrowing would open up at that point when you're at that very early stage with your e-com business?
Yes, good question. So typically, it's all dependent on the performance and the growth rates, right? So we don't it's not we don't do cookie cutter funding. Typically a good benchmark would probably be, in each tranche, somewhere between 50 to 60, 70% of your monthly revenue, right? So if you've got 20K monthly revenue, you can assume you're going to get somewhere between 10, 15K of funding. But then what will happen is you'll be able to get that quite frequently. So over the course of the year, you might be able to draw that down 4, 5, 6 times, depending on how fast you're growing and what your performance is. And so that's why when you're comparing it to a bank loan, you might say, oh, well, again, if the bank will give me money, the bank will give me X. It's sure, but they'll give you that now, and they're not giving you any more money basically for the next 2 years. So the next 3 years. Whereas our initial funding amount might be smaller to start, but what it means, but you can actually draw it down multiple months a year.
Yeah. Interesting. And how do the interest rates compare with you guys versus a bank loan versus, credit card, we obviously know is high if you get into not paying it back, but compared to a bank loan sale, you guys similar? Is it more? Is it less? Yeah.
So typically we're going to be a bit more than a bank loan. And the reason being is that we don't take collateral. So we don't take any collateral or
so you're taking more
security. So we're taking a lot more risk, but then the flip side of it is for the business, they're also accepting a lot less risk. Right? Yeah. So if you're getting funding from the bank, you're going to have to put up some assets. If you don't have assets in your business, you might have to put up personal assets. It might be your home, right? That's a big risk to put up. Your business doesn't go well.
Yeah.
We're not taking that risk. Or the business isn't taking that risk when they work with Wayflyer. So, and what we do is we just charge a flat fee. So it's not actually interest-based. So it doesn't matter how long it takes for you to repay us, right? What a bank wants to do is give you as much money and lock you in for as long as possible so that they're earning interest on it every single month.
Yeah.
Whereas with Wayflyer, you know exactly how much you'll pay. And the rates, our fees are typically somewhere between, I would say 2 and 5%. So if I give you 100K and it's a 3% fee, you're going to pay me back 103,000. And it doesn't matter whether it takes you 2 months, 4 months, 6 months, it's always going to be 103,000. So in terms of dollar amounts, you know exactly how much you're going to pay back.
Interesting model. And is that similar to the other businesses doing a similar model to you guys, or is this quite unique to Wayflyer?
So there's a couple of other people who also provide revenue-based financing. I think where we stand out is actually on the rates that we're able to provide is one of the biggest things. So we have ourselves, we have to raise the money from somewhere. So we have raised money from really big, tier 1 financial institutions like JP Morgan. So, and what that allows us to do, and because we're able to get that at low rates, we're able to pass that on to our customers. So we've basically spent, ever since we were started, we were okay, our goal is to get the best e-commerce brands in the world so that we can then raise debt at the best rates, which we can pass on to our customers. So that's really one of the biggest things that we do. And then the second thing is around flexibility. So we talk about, how you're going to need different amounts of money at different points throughout the year. Like it can often be very lumpy seasonal business if you're running an e-commerce brand. And that's a big thing we do is we actually structure our deals all around that. So there's no cookie cutter stuff, which you might get from other providers. We're actually going to look at exactly what you need when you need it and then tailor it so that you get the money that you need, but you're not paying for any more that you don't need, right? You don't be paying for money that you just don't need in your business.
You don't need your Christmas stock now, so why borrow the money now? Yeah. Well, you do need it now. But next year you won't need it for a while. Yeah. So interesting. Okay. And do you guys, how do you advise e-commerce businesses to put together forecasts? I mean, that's something in the agency we do a lot of, helping our clients figure out what they're going to get as a return on ad spend and also what their kind of baseline organic numbers are and trying to predict those into the future. Do you guys have any tools or tips on how people can figure out what they expect their business to need?
It's a really good question. I don't think I have any magic answers for you. It's something actually we talk about a lot. I was talking to a guy called Paul Waddy, who is Wayflyer strategic advisor, and he also works with a lot of businesses in Australia, helping them to do exactly this, right? To forecast out their cash flow. He had some pretty good tips. So he says that forecasting is really hard. So don't try and be perfect with it, but revise it very, very often. So he's like, build your 12-month budget, but then revise it every single month. And he was like, until you get within 5% of your forecasts, you're not actually forecasting accurately. And I think that's actually a really good piece of advice. He's like, don't build your forecast for the next 6 months and then just never
leave it there.
Leave it there. Every month, okay, how did we do against this month's forecast? If we were out, why were we out? What kind of assumptions did we get wrong? Okay, let's fix it for next month. How can we improve? Okay, we're still 10% out. What can we do better the next time? I think that's the best thing because things are just changing so quickly now that your forecast gets out of date very fast.
Yeah. Yeah, that's interesting. Yeah, I mean, our team are really good at forecasting the return on ad spend we're going to expect. We use seasonality. We look at what cost per clicks we've seen, what conversion rates we've seen. We put in assumptions around how much we think will improve the conversion rate, how much we think the return on ad spend can be improved. And then we crunch all that together. We've got a template for it. It's pretty awesome. Anyone who's listening to the show and wants a copy of the template, I'm very happy to share it. So just get in touch via the website. Little plug there. But yeah, that's a free tool we have developed and it's pretty amazing. But then what we find the trickiest to forecast is the organic uplift from the paid media. So, and especially now that iOS 14 has made things even more muddy. So it used to be that you could say, well, that was the tracked sales and then everything else that wasn't tracked is your organic. So now, some of that organic could be having come from your advertising, but also there's the other nuance of as you grow, your organic will grow because word of mouth will grow and people will just come back by their own means without having seen an ad. So that's what we find the hardest part to forecast. We can forecast the results of the ads really predictably, but how the rest of the business will be impacted by the ads in addition to what we can see in the tracking and what we expect as the uplift is really hard. And so I do feel for our clients and for brands trying to figure out, in 12 months time, what will our sales look like? It's not an easy job, especially with attributions being so difficult now.
100%, 100%, super, super difficult. I mean, I think the one thing that I would add to kind of this conversation around forecasting is most people will have a revenue and expenses, their forecast, their profit and loss. Not everyone has a cash flow forecast, and that's super important. If you don't get one, you have to get one.
Yeah. Yeah, that's something that we as an agency, we've never tried to provide because we're predicting the marketing and the results of the marketing, but we can't, we're not financial analysts much as we'd love to be. So caveat on my template, it will help you predict what your marketing will provide you in terms of revenue, but it won't tell you what's left over in the bank and how much you need to borrow, that's for sure. Okay, I have one final question for you before we wrap up, unless there's anything else you want to add after that. But you must have a good nose for what a good eComm, looks like from a financial perspective. So if you were looking at a business and you were looking at their numbers, say it was a friend down the pub or whatever, and they showed you their numbers, what would you be looking for that you would say that is an awesome e-commerce business and their numbers make sense versus that's a worrying, that those are worrying numbers where that's probably not going to work out in the long term?
Really good question. I think I'm looking at a couple of things. So, right, some of these are going to be super basic, but like it's actually what matters and it's not sexy. So
Yeah.
the first thing is like gross margin, right? Like uh, what can you, because all of these e-commerce businesses are essentially built on your ability to generate gross margin, quite often like through your ability to build a brand. Right?
Yeah.
And so that's the first one I'm looking at. I'm really looking for like high gross margin. Anything like above 60, 70% is like really strong.
Yeah.
Really strong.
60 to 70. Okay.
Yeah.
Yeah. Yeah. I mean, 50 is okay, but borderline, right? And then anything 40 and under, it's going to be really tough. Wouldn't you?
Yeah,
say?
exactly. Because like you probably know more than anyone, right? Like marketing costs are expensive, and they're going to eat into your net margin.
Yeah.
And so I think that's the next thing I look at, right? It's like how much. Okay, great, you've got that good gross margin, but how much of that can you translate to your bottom line? And that's going to be like how efficient are you operationally, but also how efficient are you mainly from a marketing perspective.
Yeah.
Right. And so that's really, 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 really important.
Yeah.
And then of course we're going to look at like CAC to LTV, which is kind of one level down, but just like how good are you at acquiring customers and how good are you at getting them to come back and purchase more from you and grow their lifetime value for you over time. I think that's the big difference really between the like good companies and the great ones is their ability to like retain customers and to really expand their lifetime value over 6, 12, 18 months.
Absolutely. Yeah. I think that's what we see with our clients as well. The ones that are really dialed in on their retention marketing, getting people to repeat buy, those are the ones where the numbers just become healthier over time. So we see that organic sales number, versus how much of their traffic is coming from paid, it's going up and up and up. And so the business is just becoming healthier and healthier. And there's no substitute for having an army of customers who want to buy from you on repeat. I would say that. Yeah. So, okay. And can you be concrete with me? I know I'm kind of forcing you into a corner. So what would be a good CAC to LTV ratio? And for those who are new to these kind of terms, CAC is customer acquisition cost. So we're talking about how much it costs us to get the customer to buy for the first time, rather than, that's not just your CPA, it's your first time customer acquisition cost. And then LTV is lifetime value. So it's all the revenue you've generated from them over the lifetime since they made that first purchase. So what would be a good ratio, do you think? And what would be a dodgy one?
Yeah. So I think one caveat is kind of what I was saying earlier, right? So is it a business that's actually dependent on repeat purchases, or are you trying to make all your money off that first purchase? Like that's
huge
just the
distinction.
Yeah.
So like beauty, food, even fashion, those are like more towards the long-term LTV, whereas like large items like furniture or single purchase items would be more like you have to make the money on that initial purchase.
Yeah, exactly. Look, I think anything above like 5 to 1 is like really, really strong, right? So I think that's where, like, if you're doing above that, like you're generating 5 times the revenue from the cost that it takes to acquire a customer. I think that's good.
Yeah. Okay, cool. So because we analyze a basket of e-commerce businesses, I think there's 250 in it. It's in this database called StatList. And they say on average, marketing efficiency ratio, blended ROAS is across the industry is about 5. So that number is kind of similar to your CAC to LTV ratio. It's a little bit different, I guess, but it gives you a kind of rough indication that like 1/5 of the business is being spent on buying media, and you're getting 5 times of that back at the end of every day. So yeah, that's kind of roughly what we tell our clients is like they need to aim somewhere near there. If they're kind of much lower than 5, then they've probably got a problem. And if they're
Yeah.
higher, then they should be scaling harder.
Yeah. 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 No, definitely. I think that's definitely
Yeah.
a good way to look at it. I think if you're getting, if you are getting that, I think you're doing, you're
Yeah.
doing a good job right now.
Yeah.
I mean, like the one caveat I would call out, right, is like, we always look at this CAC to LTV, but it's like, everybody has very different opinions on how you calculate the LTV part of LTV.
Yeah.
Some people are just like, this is just gross revenue. But then there's a lot of schools of thought where it's actually, no, it's like your gross profit, like after tax from like, it's actually the money that you're going to be able to take home from these customers, like over the course of their life. And so like, that's one thing I always call out is like, when people are comparing it, it's just like, just make sure you're comparing like with like, and that whatever way you're calculating LTV is the same way as, that you're comparing yourself to.
It's a huge difference, right? Because if you're only making actually 20% profit at the end of everything, then you're going to have to it's going to take a long time to get to 5 times the cost of acquiring the customer. Yeah. I mean, a few of our clients use a tool called Lifetimely, which predicts the lifetime value over time. And it looks at where that customer was acquired and what that kind of break-even point is. Have you seen any other tools you'd recommend, or anything that makes it easy to calculate lifetime value?
So in terms of forecasting, no, I would say, and I always tell people to be conservative with forecasting LTV, right? Because it's very easy. I've done it before, right? Like, it's very easy. You build your models and you're like, oh yeah, I think everyone will, come back once every 3 months. Like, why not? And then it doesn't happen. And suddenly LTV is like, fractions of what you thought it would be. So we, actually at Wayflyer, so what we also provide some marketing analytics software to our customers. So because we're kind of ingesting all the data to be able to analyze their ability to take finance, we have a lot of this data on CAC and LTV and whatever else. So we resurface it to them through our dashboards. But again, it's not forecasting LTV, right? It's like, this is the LTV of the cohorts that you've acquired to date.
So
yeah, but so it's going to be less than the ultimate LTV. They are, of course, some fraction are going to come back and buy more in the future, but that it's real.
It's real.
And so it's your base case. It's your
so anything else is a bonus. Yeah,
exactly.
Yeah, because if you looked at L'Oreal at the LTV of their customers now, since they've been around for decades and decades, it's not them that just went busted. Anyway, a makeup brand that's been around for years, say, their LTV could be thousands. But when they were first started, they wouldn't have been able to bank on those thousands of dollars that a customer would ultimately spend with them. So it's about being realistic. Yeah, when I was at Etsy, we used to do a lot of forecasting around lifetime value, but we always used a 2-year. So we knew that customers would stay longer than 2 years, but we based our marketing decisions on a 2-year LTV that we could predict that, they'll stick around for 2 years and this is how much we'll make from them over that time. So therefore we can afford to spend this much to acquire them.
Yeah.
So I think 2 or 3 years is probably safe, really, isn't it? Cool. Okay. Well, I learned tons today. I'm sure our listeners did as well. Is there anything else you would like to add or advise before we sign off?
No, this was a really good conversation. So
awesome.
If anybody does have, questions or wants to reach out to me about like how they're thinking about financing their brand, more than happy to have a chat. So maybe you can drop my
awesome. Yeah, I'll put all your details in the show notes. But do you have a main place people can find you, whether it's email or social media?
Yeah, so I think best is email. So it's just my name, Stephen.duke@wayflyer.com, or else you can get me on Twitter at Steve@Duke.
Awesome. I'll put those in the show notes. Great to have you on the show.
Thanks a lot, Jesse.
Thanks so much for joining us here on the E-commerce Impact podcast. If I can ask you one favor, can you please make sure you subscribe? And if you can, leave us a review. It helps us have a much bigger impact with what we're trying to do here at the E-commerce Impact podcast. Now, if you're ready to take your e-com store to the next level, then go to www.ecommerceimpactpodcast.com and click on the button to book a strategy call with me or my team. We offer a free order of your advertising and a custom growth plan, so you really have nothing to lose by getting in touch and jumping on a call with us. See you soon and watch out for the next episode in 2 weeks' time.